My name is Allie. My topic today was adjusting entries. If you see me looking over at my paper, it's because I have everything I need to say on my paper. But first, we're going to go over the identification and the accrual basis of accounting, or the matching principle, and the time period concept to create the need for accounting entries to be made at the end of the accounting period so that all of the income and expenses for that period are included in the financial statements. The two basic categories of adjusting entries are accruals and deferrals, and these two categories can also be separated into four different types of adjusting entries. The next thing we're going to talk about is the explanation, and it can be used in decision making by putting in your adjusting entries at the end of the year, and to make sure you represent and put information in correctly into the journals. Because you can misinterpret your expenses and income at the end of the giving accounting period. The next thing we're going to talk about is the application, and this refers to the entry, mid, and executive level professionals. First, we're going to talk about entry levels, and that is adjusting entries or journal entries used to recognize income or expenses that occurred but are not accurately displayed in your records. And you then create adjusting journal entries at the end of the accounting period to balance your debits and credits. So entry levels in this case would be people just out of college and they're new employees in a firm, like an accounting firm, or they work for a bank and they're accounted at a bank. And they would be making the entries and adjustments physically. They would be putting it into the computers, making sure that everything is there. And then we move on to mid-level professionals. And in order for a company's financial statements to be complete and to reflect the accrual method of accounting, adjusting entries must be processed before the financial statements are issued. Mid-level in this case would be a manager, and they would review and make sure everything is accurate, and they need to understand that each entry is correct and accurate as well. So they would be going over what the entry-level employees would have done. So they put it in, and then the mid-level reviews it and makes sure that everything's correct. And then we move into the executive level professionals, and that is the adjusted entries or journal entries recorded at the end of an accounting period to alter the ending balance in various general ledger accounts. These adjustments are made more closely to align the reported results and financial position of a business with the requirements of an accounting framework. And that was written by Professor Cram, in 2007. And executive level would make decisions based on the entries, like buying new equipment or new cars or anything that they would need for their business specifically. And these would be like CEOs and things like that of a business who make decisions, and they would be going over what the entry level and mid level did in the beginning. So the entry level entered everything into the adjusting entry, and then the mid level, like the manager, went over it to make sure that everything that the entry level did was complete and was correct. So the executive level therefore uses that information to determine whether or not they have enough money in their account to therefore make a new purchase for equipment or anything else that they need. The next thing we're going to talk about is an ethical issue, and the Exchange Commission states that from 2000 to 2001, Bristol Myers Squibb engaged in cookie jar accounting, resulting in $150 million in SEC fines. The company manipulated its accounting to create a false indication of income and growth to create the appearance that it was meeting its own targets, and Wall Street analysts' earning estimates during the years 2000 and 2001. In addition to the improper distribution of product to manipulate earnings numbers, which was not enough to meet earnings targets, the company improperly used divestiture reserve funds, or a cookie jar fund that is funded by the sale of assets such as product lines or divisions, to meet those targets. In this circumstance, earnings management was considered illegal, costing the company millions of dollars in fines. So this is basically telling us that they used a cookie jar fund, which was illegal. They were saying that it was a cookie jar fund to try to get around it, but they were doing or selling assets that were not to be sold and that they needed just in order to make sure that they got to their target, because their adjusting entry in the beginning was not correct, therefore misleading them and showing that they did not have enough money to therefore invest in their target or their goal in the future. So next we're going to talk about my storyboard, and for the first one, for entry level, it is giving you an example of the adjusting entries, and it just gives you like a short little clip of what it would look like, and then it also shows a, in this case, I guess it would be an employee doing that into a computer, which is how they do it now. And then for the storyboard for mid-level, it is of a man, and he is on the phone and reviewing the adjusting entry that the employee had done previously, and he is basically yelling at them saying that they did not get anything right and that it was incorrect and that the numbers were off. And then it also shows that he is trying to talk to them, showing them what they did wrong and what they need to correct to make sure that everything is in line and that the numbers line up. And then for the storyboard for executive level professionals, it shows a woman at the front in a board meeting, and she is basically trying to make decisions and show that they can use the money to therefore invest in other things like equipment that they would need. And it's basically showing everyone talking and making sure that's what everybody needs to do and that everything is lined up for them to be able to do it. I hope you enjoyed this, and I will see you next time.